What would your response be to kind of the explanations that we are being given about these bank failures?
Yeah, look, the blame lies on bank management. It's not a black swan event to know that interest rates were going to rise. Yeah, they rose more quickly than you thought, but you took out for your hedge in 2019 to maximize profits and boost short-term stock price. So the number one blame is clearly on the bank executives. They didn't take it. I was struck by how bipartisan the grilling of the SVB CEO was and his absolute zero interest in returning any of his bonuses that he's gotten over the years. But I think the regulators also have a fair amount to blame here, particularly the Federal Reserve, who regulated SVB from head to toe and was asleep at the switch, as several Republican senators pointed out.
Yeah, so, John, I'll turn to you and kind of ask the same question, because how unique do you think SVB's problems were? And this hearing is also taking place as we're not sure if there's going to still be more shoes to drop in the banking industry.
Yeah, so what I'd say, Kelly, first of all, it's great to be on your show, as always. I'd say that if to say that there's to blame the executives of these banks is to say that, like, if you were in that situation, you would not have made the same mistake. I think that is like a misunderstanding of kind of what happened at these two different banks. And I'm not necessarily an apologist for these banks at all, but I think you just have to be realistic that, like, if you go into 2020 with $60 billion in deposits on your books, and you get 2 years later, you have $190 billion in deposits on your books that were caused by fiscal and monetary stimulus. Like, what you would do in that situation is you just simply don't know what you do in that situation. And so, like, do you put it in the safest thing? Do you reject the deposits? Do you keep it off balance sheet? I mean, it's just so unusual what happened in this situation. In fact, like, I've kind of gone back all through history in banking and kind of identified the one other time where you had a situation like this and what happened in that situation. And then you have to go all the way back to the 1830s. And in 1834, Andrew Jackson, basically, he was trying to get rid of the second bank in the United States. And he basically said, we're going to take the deposits out of that bank, and we're going to distribute those deposits to state banks. They called them pet banks. And so they put all of these deposits into these banks. And what happened to those banks? Well, if you look at the three banks in New York City that got the deposits, it was Bank of America, Mechanics Bank, and what was the third one? And Manhattan Bank. Two out of those three basically came within a hair's breadth of failure. So they didn't totally fail, but it was the same exact situation. And so you just have a situation where it's like you have all that money dumped on these banks. They have to do something with it. What are they going to do with it? Like, it's just a very difficult, I think we have to be more realistic about assessing blame in situations like this.
I see Aaron reacting. I think you're saying you would have done something different, Aaron Klein. What is that?
I mean, you don't have to go back to 1830 to see explosive growth, huge leverage at the home loan banks, which was something that Countrywide and IndyMac and other folks did. The idea that these bank CEOs were just passive people with deposits being dumped on them kind of belies basic logic. Look, it was a fast growth strategy where he didn't consider banking 101, which was interest rate risk. He bought a bunch of safe securities on a credit risk side in terms of the 3% and 4% mortgages that people used to be getting, but they had interest rate risk. And everybody knew there was risk. That's why they had hedges. But they took the hedges off because it boosted short-term profits. They didn't have a chief risk officer for 9 months. Look, America has 9,000 banks and credit unions. Low interest rates are a common denominator across the entire industry. These banks didn't know what they were doing. They screwed up. They failed. And the regulators were often asleep at the switch in that process. But it's not some implausible concept that you have to go back to 1830 to find a scenario where interest rates rose sharply and banks didn't hedge their risk.
No, but I think the point is, when's the last time you've seen a bank grow its deposit base by 3.5x in 18 months' time? John, let me have you respond to that before Leslie, I give you a quick last word.
Well, I mean, I appreciate his point, but you do actually have to go back to 1830 to find a comparable precedent in this situation. And I mean, just the fact of the matter is that if these banks were going out and growing intentionally, going gangbusters, growing, what would you see? You'd see massive new customer acquisition. Did we see that here? We didn't see that here. We saw existing customers, a ton of liquidity flooding into their accounts. That liquidity had to go somewhere. And so, any bank, and I've talked about this, Kelly, like the rule in banking is failure. That's the general rule. The exception is survival. So any bank that fails, in a sense, it is the fault of the management. But the situation here was so unusual that I'm not sure that anybody in that situation could have avoided failure, given the incentives and how all that stuff works.